If you've ever sat there and wondered whether one line on a tax return could quietly pull the IRS into your life, you are not being paranoid. You are asking the right question. Most people think an IRS audit begins when somebody does something illegal, reckless, or obviously dishonest. That sounds neat. It sounds moral. It also happens to be wrong. I have watched people do foolish things with money and never hear from the IRS. And I have watched careful, law-abiding, disciplined people end up in an audit because they misunderstood how the system actually works. That is the first thing I want you to understand. The IRS is not sitting there like a movie detective trying to prove that you are a villain. It is running a process. It is looking for patterns, mismatches, losses, missing support, and anything that does not line up cleanly on paper. If your return creates enough friction, the machine pulls you in, and once it pulls you in, the burden is not where most people think it is. A lot of business owners carry around a comforting fiction. They think that if they followed the law, they are safe. They think legality is the shield. They think a good intention plus a reasonable deduction equals protection. I wish that were true. It is not. In an audit, the government usually does not begin by proving that you did something wrong. You are the one who has to prove that you did something right. That is the game. The IRS can ask one brutally simple question. Can you prove this? That is all it takes. You can have a deduction that is ordinary. You can have a deduction that is necessary. You can have a deduction that fits the tax code perfectly. But if the IRS asks for support and you cannot produce it in a form they accept, they can reverse it anyway. That is the part people never see coming. They say, this deduction was allowed. They say, my CPA said this was fine. They say, I followed the rules, and the system says something much colder than that. Show me. That is why so many people walk into an audit thinking they are going to discuss principles. And instead they end up losing on paperwork. I want you to picture something very ordinary. You pay for a business expense on your card. The money left your account. The expense was real. The purchase was connected to the business. Years go by, the IRS asks for proof. You open your files and all you have is a bank statement and maybe a credit card statement to you. That feels obvious. The money went out, the expense happened, end of story to the IRS. That proves only one thing. Money left your account. It does not prove what you bought. It does not prove why you bought it. It does not prove the business purpose. So the deduction dies right there, not because it was illegal, but because your support was too weak to survive inspection. This is where the mythology of audits needs to be destroyed. The IRS is not a philosophy seminar. It is not a place where the best explanation wins. It is a box checking system. If the checklist is not satisfied, the answer is no. That is one of the most valuable things I ever learned about taxes. You do not win because your position is morally fair. You do not win because you can explain it beautifully after the fact. You do not win because you meant well. You win because the file already contains what the examiner needs before the argument ever begins. There are some technical situations where the burden of proof can shift back to the government. But in the real world, most taxpayers never get there. Why? Because to do that, you have to maintain proper records, comply with the substantiation rules, provide credible evidence, and cooperate fully. That sounds easy when you hear it fast. It is not easy when the records are scattered. The receipts are gone, and the explanation is being built years later from memory. So let me strip away the comfort and give you the truth. Following the law is necessary. It is not sufficient. Support is what protects you. Now, once you understand that, the next question becomes obvious. What actually causes the machine to focus on one return instead of another? This is where most people hurt themselves without even knowing it. The biggest trigger I see is losses, not because every loss is illegitimate. Plenty of losses are perfectly legal. New businesses lose money. Real estate strategies create losses. Depreciation creates losses. Short-term rentals create losses. Schedule C businesses create losses. All of that can be real. But losses attract attention because they are one of the fastest ways a taxpayer offsets other income, and the IRS knows that. That means if your return shows losses, especially losses that meaningfully reduce the tax bill, the probability of scrutiny goes up. The return starts looking more interesting to the machine. And once the machine is interested, the questions begin. Is this really a business? Is this really a rental activity with the level of participation being claimed? Is this a genuine trade or business, or is it a hobby wearing a costume? Are these deductions real, ordinary, necessary, and supported? That is why repeated losses are dangerous territory, not automatically wrong. Dangerous, a lot of people hear that and make the wrong leap. They decide the answer is to avoid legal deductions because they are afraid of attention. That is not the lesson. The lesson is that if you are going to operate in areas that naturally create scrutiny, then your records have to be stronger than average, your support has to be cleaner than average, your system has to be better than average. Because if you are going to take a position that saves real money, you should assume somebody may eventually ask you to defend it. Schedule C losses are especially sensitive because they often sit on top of businesses that are small, loosely organized, and poorly documented. A person starts a side business, they mix accounts, They pay for things personally. They save some receipts and lose others. They believe the expense was real, which it often was, but belief is not a file. Then the letter comes. And now they are trying to rebuild the past with partial records and memory. That is an awful place to stand. There are other triggers too, and they usually share the same underlying feature. They create inconsistency. They create a return that looks unusual relative to the taxpayer's income, industry, or pattern. Amended returns asking for large refunds can do it. Vehicle deductions on a personal return can do it. Income mismatches from 1999s can do it. Deductions that look abnormally high for a given profession can do it. And one of the most important things to understand is that many audits today do not even arrive like a dramatic full-scale attack. They arrive as correspondence audits. A letter, a request, send support, mail proof, clarify this item. People underestimate those letters because they do not feel like a true audit. That is a mistake. A correspondence audit is often one of the most efficient weapons the IRS has because it shifts almost all the burden onto you. If you do not respond exactly the way they want, the deduction gets reversed and the case moves along. Minimal effort on their side, maximum disruption on yours. That is why I tell people not to obsess over audit myths. Home office deductions, for example, frighten a lot of taxpayers because they have heard for years that a home office is an automatic red flag that is mostly outdated thinking. The deduction itself is common. It is not the existence of the deduction that causes the problem. The problem is weak support, inflated percentages, or a story that makes no sense. The same thing is true for cost segregation. The strategy itself is not some exotic scandal. It has been around for a long time. What gets people in trouble is not the strategy by itself. It is the loss combined with poor documentation, weak participation logs, bad implementation, or a return that cannot tell a coherent story when examined. That is the pattern beneath all of this. The strategy is not usually the thing that kills people. The lack of support is what kills them. Now I want to talk about something people do not appreciate until they have lived through it. Audits are expensive even when you win. That sentence matters. A lot of people imagine the best case scenario as some kind of victory. They imagine they proved their case, the deduction survives, and life goes on. But even that best case scenario usually costs months of time, emotional energy, record gathering, explanations, professional fees, and distraction. And at the end of all that, what do you get? You get to keep the position you already took. No prize, no upside, no return on the time, just survival. That is why the real objective is not to feel brave enough to survive an audit. The real objective is to structure your life so that if the audit comes, it moves through quickly, cleanly, and with as little friction as possible. That is what being audit ready actually means. It does not mean hoping the IRS never notices you. It means your records are so organized, so coherent, and so immediate that the process becomes administrative instead of emotional. That distinction is everything. I have seen business owners walk into an audit with beautiful confidence and terrible systems. Their books look roughly okay. Their bank records were present. They knew the expenses were real, but they did not have the receipts tied to the transactions. They did not have business purpose documented at the moment. The expense happened. They did not have a ledger that told the story cleanly, and they lost deduction after deduction after deduction, not because they were crooks, because they were late in documenting, late in organizing, late in understanding what the system would require. Then I have seen the opposite. A client goes in with a clean general ledger, receipts attached to the relevant transactions, notes explaining business purpose, separate accounts, and records made in real time. The examiner asks for support. The support is produced. The process may still be annoying, but it is no longer frightening. The file does the talking. That is where you want to be. And timing matters more than most people realize. Documentation created during the audit is weak. Explanations built after the fact are weak. A judge or examiner looks at those and sees something self-serving, something constructed after the problem appeared. That does not mean all late evidence is useless, but it means its credibility is much lower than a record made contemporaneously. When the expense actually happened and nobody knew whether it would ever be questioned, that is why a real accounting system matters, not a shoebox, not a folder full of screenshots you promise yourself you will sort later, not a spreadsheet that tracks the amounts but not the support. You need a system that ties the transaction to the receipt and the receipt to the business purpose and the whole thing to the books. Because when the IRS asks for the general ledger, and they often do, you do not want to begin your reconstruction project at that moment. You want the story already built. And if you are operating in a higher scrutiny zone, losses, large deductions, short-term rental strategies, real estate professional status, heavy vehicle write-offs, anything like that, then you should behave as if an audit is not impossible but plausible. That one mental shift will improve the quality of your record keeping immediately. You will stop treating documentation like an optional chore and start treating it like insurance. The truth is simple. Ideas are not protection. Strategies are not protection. Tax opinions without implementation are not protection. Protection comes from clean records, separate systems, good books, attached support, and a file that makes sense before anybody asks questions. That is what real planning looks like. It is not just the idea, it is the evidence. Now let me bring this all the way down to the level that matters most, because people fear audits for the wrong reason. They fear them because they think audits are mysterious, random, and impossible to predict. That is what creates the anxiety, the feeling that one day some invisible authority may just reach down and drag you into a fight you do not understand. That is not really how it works. Once you understand the law, the triggers and the fix, audits become much less mysterious. The law tells you that the burden is on you, the triggers tell you where attention naturally gathers, the fix tells you how to build a file that survives inspection, and once you know those three things, the whole system becomes more predictable. The IRS is not magical, it is procedural. It is a machine that compares, scores, requests, and checks boxes. So the goal is not emotional. The goal is mechanical. Make the story make sense, make the records easy to follow, make the support immediate, make the examiner's path easy. When you do that, the fear starts to disappear because there is nothing left to improvise. And that, in my experience, is what actually protects people. Not confidence, not slogans. Not the hope that if they were honest enough, the system will treat them kindly. Support protects you, organization protects you, preparation protects you. If you are building a business, taking deductions, creating losses, or using strategies that save real tax dollars, then act like a serious operator, separate the accounts, keep the receipts, attach the business purpose, clean the ledger, review the return before it is filed with the mindset of an examiner, not an optimist, because once you understand how this game is really played, you stop asking whether the IRS is random and you start asking a much better question. If they asked me to prove this tomorrow, would the file win without me having to tell a story? That is the standard. That is the test. And if you meet it, audits stop feeling like chaos and start feeling like paperwork.